Hello everyone and welcome to the Mortgage Administrator online event. This is the first session of the day, and I'm delighted to be joined by Tim Bannister, Director of Rightmove Data Services, and Jennet Siebrits, Head of Research at CBRE, who will be discussing the current macroeconomic landscape and what the impact will be on mortgage lending. If you have any questions, please submit them in the question box below the presentation screen, and they will be queued up to put to our panelists, and we will do our best to get through as many of them as possible. So welcome both.
Hi.
Hi.
So to kick off the panel, the housing market was quite strong during the pandemic, and that activity has continued post-pandemic. Do you expect this to continue? I'll go to Tim first.
Well, yeah, I mean, it's been a very challenging last couple of years, but from a property perspective, it has been an incredibly active last couple of years. And I'm not sure anybody really predicted that when we first went into lockdown back in sort of March, April, May of 2020. One of the things we could see at that point, very, very early on, actually, after the lockdown started, that people were starting to reassess their own home environment, look at where the homes having to work that much harder for them, they're homeschooling perhaps, or they're working from home, exercising from home and so on. And what we saw was that quite quickly people wanted to move. They wanted to change their homes. They wanted a number of different attributes about their homes, more space, for example. And so since that point, we've seen really strong desire to move. It sort of powered through 2020. Obviously, there were some incentives and so on as well during 2020 and into 2021. It carried on through 2021. And actually, what we're seeing at the moment is a continuation of that. In our last house price index at Rightmove, we had another record level for house prices. That was the 5th in a row. And yeah, the question is, where can this continue? Obviously, there are a lot of headwinds. I think we'll talk about a few of those as we go through today. But what we're seeing at the moment, from our numbers, we get quite a good early read of where things might be heading based on demand that we see for property. And that's people coming onto our site and inquiring about a new home. So actually reaching out to an estate agent or a letting agent about a new home. And those numbers look very strong, certainly compared to where they were last year. If you look at, which itself was a very strong year, when you look at level of competition, supply and demand dynamics, they're off a little bit from where they were at the beginning of the year. So we think that it's easing, but it's still at very high levels. So I think at the moment, for the coming months, whilst we're seeing a bit of easing, we are still seeing that supply and demand imbalance mean that there's support.
Great. Jennet, do you have anything to add to that, or what do you agree with Tim?
Yeah, I mean, I do agree. I mean, if we think about it, during the pandemic, actually, the cost for many people to buy a property, to move, was really, favourable. I mean, we have record low interest rates. I mean, mortgage rates were incredibly low. And, as Tim alluded to, we did have a stamp duty discount, which did help support some buyers. Basically, buying a £500,000 home, you got £15,000 off. And, as Tim said, there was a lot of sort of migration out of cities. I mean, why would you want to live in a very expensive, rent a very expensive one-bedroom flat in the centre of London when you weren't expected to go into work and you couldn't even enjoy the sort of, the cultural and, leisure activities that went alongside it. So we found a lot of people sort of moved out back, younger people moved back with their parents. And as Tim said, we had a lot of the more affluent cohort were moving sort of, we saw a lot of an exodus out to the suburbs and out to green areas. And, and these were more expensive properties. Now, I don't know, again, Tim probably has more of information. We have sort of started seeing a bit of a reversal of these trends. And I know we've seen quite a lot of more established workers, should we say, not quite young professionals, should we say more older professionals who did move their families out of London. Now, actually, we're seeing there's more of an interest for sort of one-bedroom studio flats because, of course, Now there has been the return to office and people are wanting to go back, not 5 days a week, but 3 days a week. Actually, I love my house in Suffolk, and I thought that I could travel in 1 day a week. But actually, if I'm going to be in 3 days a week, I'm going to want somewhere to put my head down for those 3 days. And so we have found it, interestingly, a pickup in demand for these sort of smaller one-bed studio flats for people to live in while they're living in the city centre. And, notwithstanding we have had some interest rate rises, again, the cost of borrowing is still relatively low. And it's kind of a little bit of a, course. But for those people who can move, for those people who can afford it, the cost of borrowing is still relatively low, although it is moving. And there is a very strong relationship with GDP and GDP growth and activity in the housing market. So when we came out of COVID and we had a massive spurt in GDP, we uplift in the market. But GDP is starting to soften now, and there are, as again as Tim said, some headwinds, which are going to start impacting on supply, well, on demand. And Tim, on the supply side, are we still finding that there is a lot of activity, a lot of people putting their properties on the market? Because my impression that
stealing my questions, Jennet.
Oh, sorry.
It's all good.
Yeah. Sorry, Anna. Yeah, well, to Jen's point, so I totally agree. The story, certainly through the latter part of 2021, was just not enough stock. There was so much demand and not enough stock coming onto the market. So the market became very, very frenzied, really, really quick. We saw the time on market, the metric we look at, so the time the property comes onto Rightmove to the time that then it is taken off, marked as sold subject to contract. It's that initial marketing bit until you agree an offer. That hit 31 days, which was like the quickest we've ever seen. In our last month, it was 32 days, so still really, really quick. But yes, we have started to see, encouragingly, more stock starting to come to market. So sort of up 7% year to date on where we were last year, which is really, I think, positive. And that has impacted that supply and demand balance. So there's still pretty strong demand, but the supply coming up has meant that level, we look at a metric we call competition, so the number of people looking per available property, and that has been easing a little bit, which I think it's still at very high levels. It's more than double where it was in pre-pandemic times, and well above the 5-year average in leading up to the pandemic. So it's still double that. But it has been coming off a little bit, and I think it's largely because of more stock coming onto the market, which I think is really encouraging. And will obviously play a role in the number of transactions, the number of mortgages that the mortgage administrators on the call are going to be sort of working with. Yeah. We are seeing more stock coming on, which is encouraging. But it's still very, very quick market. Yeah. Not as quick as it potentially, or we're likely to get slow down a little bit, but still quick.
Well, that's good to hear there's more supply coming onto the market. And you both mentioned headwinds there, and obviously two really important ones are interest rates and inflation. Where do you think that those will land by the end of the year, and what will the impact be on the mortgage market? I know, Jennet, you said that the cost of borrowing is still relatively low.
I think inflation is probably the biggest headwind for the economy and for the housing market. It surprises me as an economist. I don't remember a period before where something like the cost of living has been played out on every single news bulletin that you watch and is in every single newspaper or report on the media consistently daily for so long. And it's really, it's really been, it's there right in front of us. The cynic in me would say, we're kind of talking ourselves into a recession because, actually, it's there all the time. My husband keeps telling me to turn the lights off, and things like that. And I'm like, I get your point, but, we're not, luckily we're not kind of on, on the breadline. But I know there are a lot of people that are seriously affected by this cost of living, and it's almost like we've had a perfect storm. you know, obviously the energy prices, which were going to go up anyway, which have been going up, you know, before, but then, you know, with the tragic events in the Ukraine, that's impacted more. So we've had a kind of double whammy there. We've had other impacts from the Ukraine crisis, such as material prices, wheat. You know, they should have been sowing the wheat for next year. They haven't been, so that's going to affect us, and just getting wheat out. And so, you know, all of these kind of things have been acting. I mean, you know, I don't know if you know, anyone can recall the boat that kind of ran ashore on the Panama Canal. Well, that in itself would have caused an uptick in prices, because what happened is we had to, you know, divert all the boats around that were coming from China, and it caused, you know, massive disruption. That in itself would have been bad enough. But when you combine it with everything else, that's what I mean, you know, this massive perfect storm, you know, and all the, you know, the young, fresh-faced mortgage advisors won't remember inflation of 9% before. But, you know, I'm talking about when I've obviously got a toddler memory, because, you know, but, you know, I remember when we had inflation, you know, at this rate, you know, this rate and this level before. But this is absolutely unprecedented. And so, you know, it is really affecting people's sentiment. And as we know, well, you know, one big thing, not only for the economy is sentiment, but also for the housing market. But we have found that there's been a retrenchment and people have stopped spending. And spending was going to be the big thing that drove the economy this year and going into next. And so the economy is going to be weaker, and people are sort of, you know, I don't know whether I should spend. And of course, we have seen interest rate rises, and interest rates now, you know, we're expecting them to get up, you know, not quite 3%, but, you know, sort of maybe 2.25%. And, you know, this is going to be a massive shock for many of the younger generation who just have never seen interest rates, you know, go up as sharply as this level, and it, you know, and it will increase our cost of borrowing. But the good news is that it, you know, and everyone who's heard me speak, you know, for the last year has heard me say inflation is transitory. We genuinely do believe it is transitory, because it is caused by these specific impacts. The one thing that, you know, we are starting to see sort of non-commodity energy prices starting to fall, etc. So, you know, there are signs that inflation will start coming down from its peak, and could well be under its 2% target sort of this time next year. But the really, you know, the one thing we need to watch out, you know, and I don't like to sound like Boris here, but actually is the potential for wage inflation, because that is where you will start to get the cyclical impact on inflation, and that's when it'll no longer be transitory, it'll be longer.
Great. And so, Tim, how are lenders reacting to all of these different factors, and what, you know, do you think their kind of reaction will change in the short term?
Yeah, well, I'm not a lender, but from observing from the outside in, I suppose what we can already see is, and we have seen, is that there has been a reaction, obviously, in the rates that lenders are offering. You know, we can see that, you know, that was happening already. You know, the rates were starting to edge up, and they have edged up. You know, I think the rate for was it 90% 2-year fixed, 90% LTV 2-year fixed mortgage, getting up towards sort of the high 2s from the high sort of 1s in the last, so from comparing the beginning of the year to now. So we've already seen a move. But I think the number of products out there from lenders is still well above where it was this time last year. So lenders look like they still want to lend. I think the majority of it seems of those sort of rate increases, or the stronger rate increases, have been in those lower LTV bands, actually, from what I've seen, you know, which were very, very low, and they've been coming up. Perhaps to the point around Jen's point around sort of how transitory this might be, you know, the 5-year rate's getting closer to the 2-year rate, so potentially it's the earlier stages that we expect to see these rates these rates sort of impacting. So I suppose that's what we've seen, and obviously that has led to the fact that you know, first-time buyer, we're tracking for affordability for first-time buyers, and we can see that the rate that they would be paying on a typical first-time buyer mortgage, sort of an entry-level kind of mortgage, that 90% 2-year fixed, you know, that's sort of the £950 per month if you're thinking about first-time buyer property, and that's now above where it would be for rent, which you think is for a similar type property is more like £900. So yeah, I think we've seen that sort of acceleration about the cost come through already this year. But as I say, I think lenders still are keen to lend, which I think is really good news. They still seem to be wanting to lend. Clearly, they've had the mortgage market review came back in 2014. Lending criteria and affordability checks have much more stringent, responsible lending compared to where we were back 2007, 2008. And as a result, I think they seem to be more comfortable continuing to lend despite some of these headwinds. So I think that's good news. But obviously, anytime costs go up, they're going up in the general economy, they're going up in actually your mortgage payments. That is going to make you think. And certainly, some people will make them think about their next move. Will they, can they afford to move? Can they afford the property they want? Or are they going to have to change their behaviour? At the moment, it looks like they're continuing to want to move. So that's what we're seeing. And as Jen says as well, I think a lot of this has been very well reported. So we had been expecting interest rates to go up anyway this year. That's what the expectation was. We've been talking about it for quite a while, and we'd expected there to be inflation. I think it's probably more than people had expected based on. I don't think people had predicted a war, the invasion in Ukraine. But outside of that, there had already been this prediction and well-reported sort of headwind. Okay. So I think that seems to be the reaction from the banks. Continue to lend, increase in the rates as you would expect, and at the moment the reaction from people wanting is that they're still looking to move, perhaps easing a little bit, but still wanting to make that move.
Great. And so we kind of mentioned the mortgage market review there, and one of the big things that's come out recently is the removal of the stress test. And I was just interested in what you think the impact will be on lenders and borrowers. And so, Jennet, do you have any thoughts on this?
Yeah, I mean, if I was completely candid, I suspect it won't have a lot of impact, to be honest. I think that lenders are still going to be quite, what's the correct word? Lenders want to lend, we know that, but they want to lend safely. And, the global financial crisis taught us that. So the stress test may not be a legal requirement, and it may not be something that they do, but I suspect that each individual banks will have their own stress test that they will want to do, because they don't want, lenders don't want to lend to someone that is going to get into trouble. It's not in their interest. They don't want to have to go through a repossession process. It's in no one's interest to do so. So I think lenders will still lend responsibly. I think that that they won't have to use this kind of 3% above and things. But actually, if you think that before, when interest rate, I got a mortgage out remortgaged end of last year, and it was 0.99. Part of my mortgage I had to redo a few weeks ago, and it was 2.99. So it has gone up significantly. So I think if the stress test was still there, the difference for me would have been whether I could borrow at current rates, because that would have been the stress test, basically, broadly at the stress test, or whether I could borrow at kind of 6%. So I think it won't curtail the level that they can lend at, because it'll be the same cohort that they could have lent at a few months ago. But I think lenders will still be responsible, and I think which is what we want. But I don't think we'll see a marked impact. I don't think we'll see a massive influx of people being able to borrow, because interest rates are that bit higher anyway.
Great. Tim, do you agree with Jennet, or do you?
Yeah, absolutely. I think 100%. And speaking of people in the industry, I think there are other, they will still do their own test, just as Jen says. They want to lend responsibly. It's not in their interest not to. And also there are other sort of elements still in there which will capture affordability. So the LTI, so the loan to income ratio, is at the moment at least still at 4.5 times. Unless you have that sort of percentage which they can do above that. But that 4.5 times for the vast majority of their lending is going to capture, it actually is given where prices have gone and how wages have moved, that actually is the thing that's sort of putting a cap on lending, perhaps more so than the in general than that 3% stress test. And obviously they still do have to do stress tests to, I think, to comply with the FCA side of things. So just not the 3%. So I think there are still elements in there which will capture and do a similar job to what the 3% element was, perhaps, but sort of so, but not impacting some of the people that were getting perhaps unfairly caught by that 3% cap.
Great. And so we kind of you mentioned, Jennet, a little bit earlier. So another headwind to be aware of is wage inflation. Are there any other potential headwinds facing the housing market that mortgage administrators should be aware of? And so I'll go to you, Jennet, first.
Yeah, that's interesting. I mean, the one thing that I always is at the back of my mind, and that is around the current government's fixation on buying a property, which is great. Everyone wants the opportunity to buy a property, but almost at the detriment of the rental market. And from a mortgage point of view, buy-to-let mortgages are quite a profitable part of the landscape. Now, so my kind of, I'm always a little bit kind of anxious, whenever we have a budget or whenever we have kind of some announcements of whether there's going to be more taxes on buy-to-let borrowers, or more kind of sort of, I'm saying penalties, I don't quite mean penalties, but sort of tax implications and things, because actually we do need to have a good rental market, and so if that's not working properly, that could be an issue. I mean, there is an argument to say if you have, if a lot of people have got a buy-to-let portfolio comes back into the market, that's great for sort of first-time buyers. But there is going to be this interplay, and so it will be the buy-to-let side of things. Not that I've heard anything, and I think that there is anything coming down the line, but that would be one sort of headwind, perhaps unexpected headwind, perhaps that might catch us out.
Okay. Tim, what about you? Are there any other headwinds that mortgage administrators should be aware of apart from interest rates, inflation, and some buy-to-let changes?
It's a tough one because I think crystal balls have been smashed all over the place over the last couple of years, and every time we have a headwind that we've talked about, there's a lot of talk about things that they're going to massively derail the property market over the last 2 years, and every one of those hurdles that have been thrown at it, it seems that the desire to move has just overcome it. So I'm sort of always cautious on that front. But I think there are certainly some themes or trends to look out for. We don't know at the moment really what the impact of sort of, I suppose, the increased interest and focus on energy efficiency might have, for example, in the home. So I'm not sure I'd call that as a headwind, but it's certainly something to think about that's coming down the track. How is that going to impact people's decision making? What level of regulation are we going to see? We don't really know enough about that yet. So that's certainly something to keep one's finger on the pulse.
So that's the upcoming EPC legislation.
How is that going to impact? And that might play into actually sort of some of the comments Jen's making regarding buy-to-let as well. Sort of how a landlord's going to react to the requirement to update properties, and how is that going to work across the country? Is it going to be a similar cap about how much money they have to spend to update their properties? Or is it going to be regionally focused, or is it going to be even more locally focused than that? Because that could really completely change the dynamics and the business model for sort of smaller buy-to-let landlords. But we just don't know enough about what's really happening with that. So that's something sort of an unknown. And I suppose that another element that, if I was a mortgage administrator, I'd be sort of thinking about at the moment would be, I suppose, just the level of transactions that are coming down the track. At the moment, we see there's still a strong level of demand. There's still transactions and occurring, and we see sort of a bit of a logjam on our site, at least in terms of the number of properties that are waiting to go through. So there's 500,000, I think, currently in the sort of sold subject to contract space. So I suppose that's something to think about as well, which is that there's a lot of work coming down the track where people sort of trying to progress through that process from sold subject to contract through to completion, which we think is taking us sort of 150 days now, compared to in the past it might be 90, 100, 110. At the moment, it looks like it's 150, which is up again. So that's something to just I suppose consider.
Yeah, I mean, certainly on the EPC point, on the regulation point, we've got a paper coming out, I think today on that, and we've estimated that there's about 1.79 million private rented properties that are below the proposed C level EPC. It's difficult to say because it's EPC and C. So there's 1.79 million properties that are going to need to be upgraded by 2028. Yep. Wow. That's taking out about 500,000 that can't be upgraded or will cost too much to be upgraded. So that means on an annual average, you're going to have nearly 300,000 properties being upgraded. And at the moment, if you look at the rate of issuances across EPC, at the moment there's about 122,000 are above C and above when they're being issued. So we're going to have to over double the amount that are being issued at that level, which means that we're going to have that level upgraded. So that is a significant risk. Now, you know, some of them might be a D and they might just need to put in some LED lights. So it might be quite simple, but there will be some properties that actually, you know, might need some significant sort of retrofit to get them just to a state where they will be rentable.
Wow, that's quite sobering. So I mean, do you think that households and lenders are in a better position to, you know, you mentioned recession earlier, Jennet. Do you think we're in a better position to face a downturn than, you know, we were before entering the 2008 financial crisis?
I do, absolutely, definitely. I mean, we've touched on the mortgage regulations, and also we do seem to be learning from our mistakes. So, you know, and interestingly, during the, you know, if you look at the level of repossessions over the GFC, it was really, really, really low, and it was much lower than the previous recessions. And this is because banks were much more forbearant. You know, they kind of knew that actually, you know, interest rates were low, and actually they knew that they're not going to make their money back. You know, and they're better off having people pay a little bit of the mortgage and, you know, give them a bit of a chance to kind of pay. And we've kind of learned the lessons of this. And I think, you know, we are in a better position. We're better, so the banks are in a better position. They're more forbearant. Their lending processes have been much better. Yeah. And I think that we are just much more solid in that way. So I think, you know, and, you know, unemployment is going up. We know that, but actually it's still very low. And so, you know, and I think again, as a society, we're much more willing to kind of be honest. And so, you know, the biggest thing I think from a lender point of view, and the audience will correct me if I'm wrong, is actually if you're in trouble, just go and say to your bank, look, I mean, don't hide from it. You know, if we look back to kind of, you know, the late 80s and early 90s, the worst thing was the fact that there was just no communication between lenders and households, because households were so, you know, frightened that they were, you know, if they admitted that they were in trouble. Yeah. So I think we've learned both from a lender point of view, but also, you know, as a society point of view, that, you know, if you can't make mortgage, it's not the end of the world. If you can't make your mortgage payment, you can put a plan in place, and actually, you know, you're not going to be, you know, repossessed, because it's not in anyone's interest really. So I think, you know, we are in, you know, that's my view, we're in a better position.
Great. Cool. So sorry to cut you off. I just wanted to get to some of the questions, and we have kind of covered this already, but one of the questions is, how do you think lenders being told they can scrap affordability rules for buyers will play out? Tim, do you want to have a crack at that one?
Yeah, well, I suppose we did talk a bit about it. I would say, I probably would say that they haven't scrapped affordability rules for buyers. Yeah, I think they're still pretty stringent. And they will remain so. I don't think they're going to be an impact or changing the LTI side of things, for example. From my understanding at the moment, it was looked at and decided not to. So I think there's still some pretty stringent rules in there. And I mean, to Jen's point before, I used to work in the equity markets, and we used to say that in the stock market, and we used to say that cycles are 7 years, but memories are 5. So by the time you got to the end, you know, close to the end, people have forgotten about all the learnings from before. So that doesn't seem to be the case now. So that's the good news. I think we are learning from our mistakes in the past.
Yeah, and just adding on to that, I mean, lenders are their own beasts. They can have their own rules and regulations. They don't have to, you know, they would have their own guidelines. So, you know, just because you're no longer told not to cross the road when a car's coming doesn't mean you're going to cross the road when a car's coming.
Have we lost Anna? I think we might have lost Anna.
Yep, I think Anna's. Hi, Ian.
Hi there. How are you?
Very
good. I think I'll jump in there. So just at the 11th hour, it looks as though Anna has disappeared.
Right.
I believe we have run out of time, so that's perfectly timed. But thank you very much both for a very insightful debate. Hopefully our administrator audience got a lot out of that, and certainly, I guess from my perspective, we did sort of speak a lot about headwinds, but clearly, as we've just finished with, or you guys have just finished with, we're certainly not anywhere near where we were in 2008, and everybody is resilient enough. And I guess picking up on your point, Tim, that there is an overriding desire for people to move house or change their circumstances or improve their houses to sort of match, obviously, our new way of working and how we're sort of approaching things. So that alone feels as though the mortgage market is in good health going forward, albeit, as always, fluid and changing. So sort of plenty of action for our administrators to understand and get involved in. But certainly sort of picking up again on your point, Tim, around the 500 or so thousand transactions coming down the track. I think it's fair to say everybody's going to be super busy, certainly over the short to medium term. So I think it just comes from me to say thank you very much for everybody who's listening, particularly the questions that came in. Sorry that we didn't get round to answering all of the questions, but moreover, thank you both to Tim Bannister and Jennet Siebrits. A fantastic session. So thank you very much, and we'll leave it there.
Thank you.
Thank you very much. Thanks for having us.